I think we can go ahead and get started now. So hi everyone, welcome to today's webinar. So for today's session, we're going to be talking about the 7 common mistakes that new traders make. I'm Melanie and I will be your speaker for today. Just a disclaimer as per usual. Information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Material in this webinar is just the personal opinion of the author, and the client's investment objective and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so hi everyone, I'm Melanie and I'll be your speaker for today. I'm from the company Everest Fortune Group, who are finalists for Best FX Research and Best Equity Research in 2019, 2020, and 2021. So not to worry, Desmond will be back next week. He just isn't feeling well today, so that's why I'm covering for him. But he'll be back next week, don't worry. Okay, so here's our agenda for today. So firstly, we're going to be talking about not having a trading plan. Secondly, no stop loss. Thirdly, no risk management. Fourth, chasing losses or revenge trading. Number 5, over trading. Number 6, ignoring fundamentals. And number 7, not keeping a trading journal. So for some of these, we will just skim through pretty briefly because some of them are pretty self-explanatory just from me mentioning it. I think it's pretty clear what we mean. And some of them we will get pretty in-depth into, so such as the no stop loss and no risk management. We'll give you some tips on how you can prevent these from happening and how exactly you should manage your trade. So let's dive right in. Throughout the webinar, if you have any questions or anything you'd like to point out, feel free to pop them into the chat, and I'll try and answer them as best as I can. Okay, so not having a trading plan. This is the first mistake that beginner traders make. And having a trading plan is important for several reasons. So over here, firstly, we have consistency. So a trading plan helps you to maintain your consistency in your trading approach because it outlines your trading strategy, including entry and exit criteria, risk management rules, and position sizing. So by following a well-defined plan, you are less likely to make impulsive decisions based on emotions or market noise. Consistency is crucial for long-term success in trading. Next, we have objective decision-making. So a trading plan provides a framework for making objective decisions. So it helps you define specific criteria for entering and exiting trades based on technical or fundamental analysis. So this eliminates guesswork and emotional biases, allowing you to make rational decisions based on predetermined rules. Next, we have risk management. So we'll get a little bit more in depth into this in the next few slides. But basically, a trading plan incorporates risk management principles that help you to protect your capital. So it outlines exactly how much risk you are willing to take on each trade, where to set stop loss orders, when to take profits, so on and so forth. And by implementing proper risk management techniques, you can limit potential losses and preserve your trading capital. Next, we have focus and discipline. So a trading plan keeps you focused on your trading goals and prevents distractions. So it helps you avoid impulsive trades or chasing after hot tips. Following a plan requires discipline and adherence to the rules you have set for yourself. So this is very important as well because to help you to overcome any emotional challenges that come with trading. Next, we have evaluation and improvement. So a trading plan serves as a reference point for evaluating your performance. By keeping a record of your trades and comparing them to your plan, You can identify strengths and weaknesses in your trading strategy. So this allows you to make informed adjustments and continuously improve your trading approach over time. And lastly, we have confidence. So a well-defined trading plan gives you confidence in your trading decisions. It provides a structured framework and a set of rules to follow, which will help you to reduce uncertainty and anxiety. So when you have confidence in your plan, you're more likely to stick to it during challenging market conditions and avoid making impulsive or emotional decisions. Okay, no stop loss. Okay, so let's get right into it. So the next few slides, we're going to be pretty in-depth in it's gonna be pretty in-depth into how exactly you can manage your trade. Okay, so first, in order to manage a trade, it's first important to understand what a trade consists of. So you can attend our trade management series, but I've basically I'll briefly be covering all of what we go through during the trading management series in this webinar. So let's look at anatomy of a trade. Firstly, consists of the entry, stop loss orders, and take profit orders. And how exactly you can manage these trades would be through a break-even, partial profit, idea invalidation, trading stop loss, as well as diversification. So this is what we cover during our trade management series, but I'll just briefly go through what exactly each of these mean. Okay, so why is it important to have a trade management strategy? Firstly, it helps to control risk. So trade management strategies such as stop loss orders and position sizing help traders to limit their potential losses and manage their overall risk exposure. Secondly is to maximize profits. To lock in profits and maximize returns, such as through your take profit orders and trailing stops. Third, managing emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets. So this can help prevent impulsive decisions driven by fear or greed. And next, we have improved trade efficiency. So by having a well-defined trade management plan, traders can make more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. And lastly, increase consistency, which we've already mentioned earlier. So I'm just going to move on to our next slide, which shows you exactly the problem with a fixed take profit. So let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs in line with this area. If our trading strategy requires us to have a fixed take profit of 100 pips, we would place the target beyond this strong resistance area. And you can see over here, we're expecting price to go up towards that same swing high resistance level. So this is how it played out in the end. Let me show you. This is the before and this is the after. So this is our profit target, and price shot up but missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So in an alternative scenario, if we had placed our take profit before the key resistance level, we would have got a profitable trade. So it's important to look at the charts and then adjust your take profit or stop loss accordingly. Okay, so this is the proper stop loss and take profit placement. Feel free to screenshot this if you'd like. The proper stop loss and take profit placement ensures you maximize your wins and minimizes your losses. So the stop loss should always be placed beyond the resistance area, while the take profit should be placed before. So we'll go through a couple more examples in the next few slides. So here we have trade management with FIB confluence, but this is basically applicable for any kind of area that we're talking about that involves take profit and stop loss, not just for Fibonacci. Okay, so stop loss beyond means you should always put your stop loss beyond a key confluence area, or as we mentioned earlier, a key support or even resistance area. And the reason for this is because more often than not, price is attracted to such strong areas of confluence, and if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse. So now let's take a look at take profit. So take profit target before a key Fibonacci confluence area. So it means that you should always put your take profit target before a key area. And the reason for this is because when price reaches the Fibonacci or support and resistance area, there's a high chance that you will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry or even your stop loss. So this is also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 pip. So here's an example to show you why you shouldn't have a fixed stop loss. Here we have a support level with two swing lows in line with one another. Price has bounced off this support level and we are expecting it to continue to rise to the swing high resistance. Excuse me. So our stop loss of 100 pips is fixed at the 1894.75 level at the support level. But instead of going up, as we expected, price actually goes down instead, and it touches the stop loss and bounces perfectly from the support. So instead, what we should have done is to place our stop loss slightly beyond the key level of support and resistance so that we are not stopped out at the support, as price tends to be attracted to key levels of support or resistance and bounces off of them. Okay, so this is why it's important to have dynamic stop loss and take profit placement. Dynamic stop loss is a trading strategy used to manage risk in which the stop loss is adjusted dynamically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses, and the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. Okay, here's a simple example to demonstrate dynamic stop loss. Price has bounced off nicely off the support level at 86.721, and we expect it to reverse off the entry at 87.819, in line with the 100% Fibonacci projection level. So here you can see we have this confluence area with the negative 27.2% Fibonacci expansion and 61.8% Fibonacci projection. They all line up nicely with our stop loss. And we're expecting price to drop from our entry towards our take profit. So instead of putting our stop loss exactly at the Fibonacci confluence area, we want to move it to beyond it instead, and we'll show you why in the next slide. So you can compare the two. Here we have the stop loss under it, whereas here we want it to be beyond or above. So if we had put our stop loss right at the confluence area, we would have been stopped out. You can see from this little arrow here that we've highlighted. Price is often attracted to strong areas of support and resistance before reversing off of these areas. And you can see after that, it immediately dropped back down as we expected towards our take profit. Okay, so now let's look at another example. So we expect price to bounce off of our entry at 87.625 at the pullback resistance in line with the 78.6% Fibonacci retracement. So we're expecting price to drop from our entry to our take profit. So price has hit our entry and has reversed nicely off of it, heading towards our take profit. So take note, we also have another 78.6% Fibonacci retracement that aligns nicely with our take profit. Okay, so price just touched our take profit before reversing off of it. So this is the before and this is the after. And you can see price really just with the tail of the candlestick touch our take profit and hit it back up towards our stop loss. So that's why we always say that the take profit should be placed before any major area of support and resistance or Fibonacci confluence, because it's likely to just touch it and reverse off. And you want to make sure that that price really does touch your take profit before reversing off of it. Okay. So here's one more example. We have this confluence area here at our take profit. And price has recently broken out of this descending trend line, giving us a bullish bias. So we're expecting price to continue to rise from our entry towards our take profit. And you can see here, with our take profit placed above the confluence area, price reversed off of it and missed our take profit by a few pips. So instead of placing it directly here, we want to place it below so that we make sure that price really does touch our take profit. So if we place below our confluence area, price hits our take profit nicely before reversing back down to our entry. Okay, here we have no risk management. This is our third common mistake that new traders make. And I'm combining this with our fourth mistake, which is chasing losses. So chasing losses is also known as revenge trading, which happens when you let your emotions cloud your judgment. So this ties nicely with our first point about having a trading plan and also risk management that I'm going to talk about now. Okay, let's first talk about a break even. So break even in trading refers to the point at which a trade reaches a level where the trader has neither made a profit nor suffered a loss. So it's the point where the cost of the trade, including fees and commissions, is equal to the price at which the trade was executed. So for example, if a trader buys a stock at $100 and sells it at $110, the trader has made a profit of $10. On the other hand, if the trader buys a stock at $100 and sells it at $90, the trader has suffered a loss of $10. However, if the stock is sold at $100, the trader has neither made a profit nor loss, and the trade has reached its break-even point. So break-even is an important concept in trading because it helps traders to determine the minimum price they need to sell their trades in order to cover the costs and avoid a loss. So this information can be used in deciding when to close a trade and take profits or cut losses. Okay, so here is an example of how we make use of break-even when we are trading. So break-even is a level where you are in profit and recognize that there is a risk of reversal. So here we have an entry at the breakout of the multiple swing high resistance level where we are hoping for price to push to our take profit. So our take profit is here at the green highlighted area. So take note of our original stop loss at point 2 over here, original stop loss at our swing low support. So at point 3, at when the break even is triggered, price reaches our break even level and reverses off it. Hence, we move our stop loss to the entry to protect our position. So we move it here instead. Number 4, modified stop loss. So if price continues to our position, that's good. But if price reverses back to our entry, we want to be protected. So here we can see price has broken above the break even, but has quickly reversed and hit our modified stop loss. Okay, here is another concept, partial profit. So partial profits are typically used when there is a strong resistance area and you are unsure if price will rise to your take profit. So you can read the example I've included here, but it's similar in concept to the break even. Okay, so let's look at a couple of examples of partial profit. So here's our first example, which is the Aussie dollar chart. Okay, so on this chart, we have our first support, which is also our entry, and we're expecting price to hit towards our take profit. Okay, so our first support is significant because it has a price has tested this level many times. You can see the swing highs and swing lows, and our stop loss, on the other hand, is slightly below that, and also in line with a couple of swing highs and lows. But if we look at our partial profit, how we chose it is basically at our swing low here. And it's to hit it towards a couple of Fibonacci confluence levels. So we expect price to rise to our take profit, but there is a strong resistance at the Fibonacci confluence area that I mentioned here, which is why we place our partial profit at that area. Okay, so just in case price really doesn't hit our take profit and reverses off of this area instead, we can at least get some profit out of this area. So you can see this is what happened in the end. Price really reversed off of our major confluence area because of the strong resistance area at our partial profit and reversed off it instead of heading towards our take profit. Okay, here's another example. Our entry is here. We're expecting price to hit towards our take profit. Oops. Here's our break even. But you can see, similar to our partial profit example, price shows us that the 23.6% retracement and 38.2% retracement line up nicely with this break-even level. So because of that Fibonacci confluence, we can expect price to reverse off of it, which is why we add a break-even here just in case price reverses off and doesn't hit towards our take profit. So here you can see price at our break-even. And then what do? We adjust our entry to minimize loss. We adjust our stop loss. We put it to our entry to minimize any losses, just in case really price reverses off our break even. And you can see here, luckily we did that because we still made a break even though price didn't hit our take profit and instead reversed off the confluence area towards our stop loss. And in the end, we got stopped out, but without making any losses. Okay, here we have idea invalidation now. So idea invalidation is usually placed before your stop loss. So it's a level which you basically admit, I'm wrong, let me get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So it's a similar concept to what we looked at earlier. But instead of moving our stop loss to our entry, now we're moving our take profit to our entry. Okay, so let's take a look at this example here. Our entry is over here at this multiple swing high. And we're hoping for price to drop all the way down to our take profit target, which is over here. So if we follow price, right, we can see that it reversed off over here and is headed back up. So what we do, we can see it even pushed past our entry, and our stop loss line originally is over here, right? And it's as we mentioned earlier, we want to place it beyond any major area. So since we have a swing high resistance here, we're placing the stop loss beyond that. So it's hit our swing high resistance, but it reversed off of it. So we quickly place our take profit at our entry instead, and we admit that we're wrong and hope that this gets us out of our losing trade. And you can see price immediately reverse off the take profit towards the stop loss. So we do get a break-even profit, even though we would have gotten stopped out if we didn't do this. So at least over here, we get some profits. Okay. So here's briefly the idea of invalidation if you still haven't understood so far. So the idea of invalidation in trading refers to the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information or market conditions. So here's how the process of idea invalidation typically works in trading. So we have the initial trade idea. The trader has an initial idea about a potential trade based on the analysis of market conditions, technical indicators, or other factors. And then we have the evaluation of the idea. The trader then evaluates the idea by looking at current market conditions and other relevant information, such as economic data, to determine if the initial trade idea still holds up. Next, we have invalidation criteria. So the trader then establishes criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause them to reconsider the trade. Next, monitoring. So the trader will then continue to monitor the market and the security in question to see if the invalidation criteria are met. And lastly, we have the invalidation. So if the invalidation criteria are met, the trader may choose to exit the trade or adjust their position. On the other hand, if the criteria are not met, the trader may continue to hold the position or add to it. So in short, idea invalidation is a crucial step in the trading process to help traders like yourselves make informed decisions about their trades and avoid potential losses. Okay, here's another example. So we have our entry here at the swing low and our take profit at our first resistance level. So we're expecting price to rise from our entry to our take profit while keeping note of some of these Fibonacci levels over here. Okay, so when deciding where to place our stop loss, we decided to place it beyond the 127.2, which lies in line with the negative 27.2% Fibonacci expansion. And we place our idea and validation right above that. So you can see price actually broke out of our entry and headed towards our idea invalidation or stop loss. But thanks to our idea invalidation, it prevents us from being stopped out. So what do? We move our take profit towards our entry. And then we see that we actually make break even over here. So we get out at break even. So if we didn't do that, if we didn't change at our take profit, change our take profit to our entry, we would have gotten stopped out because price would have continued to go down towards our stop loss. Okay, now we have trailing stop loss. So this brings us to our last point in risk management. So if you're still a little bit confused, don't worry too much. Feel free to let me know if you have any questions in the chat. But this is all part of our series on trade management, but I just kind of compiled all of it into this webinar because I found that it was pretty helpful as a beginner trader and it's pretty relevant for if we're talking about mistakes that new traders make and risk management strategies as well. Okay, so we have trailing stop loss, which is the last part of our risk management. So trailing stop loss is a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So here's how it works. Excuse me. Let's say you buy a stock at $100 and you set a trading stop loss at $10. So as the stock price rises to $110, the stop loss will follow. Now at $100, 110 minus $10. So if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. So the trailing stop loss technique can be a useful tool for traders because it allows them to manage risk and lock in profits dynamically as the market moves. This is different from a fixed stop loss, which is a set which is set at a specific price and does not change as the market moves. So it's important to note that the trailing stop loss is not a guarantee that you will exit a trade at the desired price. So market conditions such as gaps or rapid price movements due to volatility can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. So such as those that we've mentioned previously. Okay, here are some just a summary of the different methods that you can use for trailing stop loss. So here the first that we have is the moving average indicator. Next we have the parabolic SAR, and then we have the chandelier and ATR indicator, support and resistance levels, and then the last we have a combination of all of these methods. Okay. So here is an example of you using the moving average trailing stop loss. So sell entry is over here at our green highlighted circle. And you can see our trailing stop loss is triggered once price hits our moving average indicator. So it's pretty straightforward. You're just basically making use of the indicator to get out of a trade. So it's pretty convenient for traders who don't want to keep staring at your computers all day. This is an easy way to manage your trades. Okay, and it's a good thing that price stopped us out here, because we would have made more losses if price continued to rise over here, which is exactly what happened. Okay, next we have trendline breakout. So if we're looking at the same example but with a different technique now. So here we have a trend line, a descending trend line, and just for recap, make sure that for a valid trend line, we have 3 touches. So if we're looking at a descending trend line, we want to make sure that there are 3 significant touches on the bottom, on the underside of the trend line. So not over here, but over here. Okay. So once again, once price touches, or rather breaks out of the trend line, then we are stopped out. So that's just, it's pretty straightforward. That's how trend line breakout works. Okay, and next we have parabolic SAR. As price touches the indicator, we are stopped out. So it protects us from large movements such as this, and it ensures that we still maintain any loss, not losses. Sorry, can you guys see my screen? Okay, I'm not so sure what just happened. Okay, yeah, I'm not so sure what happened, but okay, we're back now. Can you see the screen now? The shared screen? Okay, okay, thanks, Moses. Okay. Yeah, I don't know what happened. Okay, anyway, so sorry about that. Okay, so similarly, what was I saying? It protects us from large movements or large reversals, such as this, that can hit back towards our entry and we can end up losing all of our profits that we made throughout this area here. Chandelier and ATR trading stop loss. Even though this looks a little bit more complicated, but the idea behind it is basically still the same. Um, we are stopped out when price breaks out of these indicators. Okay. Here's another example of moving average on another example now instead of, because previously we were looking at the same chart. So now we're looking at a different chart. So same thing, moving average, you can see we stopped out right when price breaks out of this moving average indicator. Okay, using breakouts as trading stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So stop loss can help you manage risk, protect capital, and the trailing stop loss can help you protect your profit. So here we have the parabolic star. Um, and this is in combination with support and resistance levels. We're just showing you how you can combine these to identify any breakouts. So I'm just going to go through this pretty quickly. Okay, next we have overtrading. So you got to trade to make money, not trade just for the sake of trading. I'm not going to get into this because it's pretty self-explanatory. Um, it's just basically trying to say that some traders, especially when you first start, you get a bit excited and you simply forget about profits and you're just looking at the movement of price. So you want to make sure that you protect your capital and yeah, make sure that you just implement all of the risk management techniques that we talked about in this webinar so that you protect your capital and make sure you remember that you are still here to make a profit and not trade for the sake of trading because it's pretty time consuming as well. Okay, lastly, well, not lastly yet, but second lastly, we have ignoring fundamentals. So let's introduce FX news calendar or an economic calendar. So I have screenshots from two websites that provide information on FX news or major news events that can impact the markets that you are looking at. So on the right, I have Forex Factory, and on the left, I have investing.com. So having a news calendar that you look at is pretty important because it allows you to see at one glance all important economic data releases. And it shows key events such as GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So it's important to distinguish between um, microeconomic and macroeconomic activity. So some news may impact a particular city, such as Tokyo in Japan or Dallas in the US. In other circumstances, a country like Germany may benefit or be hindered by economic news more than its neighbors. So extending further out, an announcement by the ECB is likely to have a greater influence on Eurozone markets than those of African nations. So this helps us keep track of the leading economic index or a range of composite indexes such as the coincident index of major economies. So we want to use the information at hand to help us to gauge the economic sentiment and volatility levels of the instruments that we're trading. So I'm just going to briefly introduce some high impact events and what exactly they mean, because these are pretty common when you're looking at um, major events from all of those FX websites. So FOMC meeting is also known as the Federal Open Market Committee and is US Fed's way of communicating their view on monetary policies. Fed interest rate decision normally comes together with FOMC meetings, and if Fed is dovish, that means that the USD is bearish. If the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay. NFP or non-farm payroll measures the change in citizens that are employed from the previous month, which excludes the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, next we have crude oil inventories. These measure the weekly change in the amount of crude held by the US firms. So if crude inventories increase, oil prices should drop. And EIA stands for Energy Information Administration and is a short-term outlook. So it's a monthly forecast for the year ahead, the demand and prices across major fuel types. So I mentioned earlier some benefits of using FX Calendar, but depending on the individual's trading style, it can help you to plan trades and allocations for the day or week or month ahead, and also help to alert you on upcoming important news that may affect volatility in whatever markets that you are trading. Okay, lastly, a trading journal. This is particularly important if you are a beginner trader. So here's just a brief run through of or checklist perhaps of how to set up your own trading journal. So it's a relatively straightforward process. Firstly, you choose a format. So you can decide if you want a physical notebook, a spreadsheet, digital document, or even a specialized trading journal software. Next, we decide on the categories. So can be the date and time of the trade symbol, entry and exit prices, position size, stop loss, take profit levels, trade duration, and trade outcome. So you can also include additional categories if you wish, such as your emotional state, market conditions, trade rationale, so on and so forth. Third, we capture trade details. So we want to record the relevant information for each trade you make. So you be consistent and diligent in entering the details accurately and promptly after each trade. So you want to make sure that you include all the predetermined parameters, such as entry and exit points, as well as any adjustments made during the trade. Okay, fourth, analyze trade performance. That's pretty self-explanatory. So you basically just look for patterns, trends, and areas for improvement, and reflect on any winning successful trades or any losses. Okay, reflect on emotional factors, review and adapt. So you learn from your past traits and experiences and continuously adapt and evolve your strategy based on your journal analysis. And it's also really important because it helps you to maintain discipline. So it helps you to stick to the discipline by recording each trade and consistently updating your journal. So it contains all the necessary information and to help you maximize the benefits of maintaining a trading journal. Okay, so using a trading journal offers several advantages. I'm just going to briefly go through this. Firstly, we have performance analysis, which allows you to analyze your trading performance in a systematic and objective manner. So same thing, we mentioned this earlier, so I'm not going to get into that. Learning and development. So basically reflect on your decision-making process, identify errors or missed opportunities, and then learn from your experiences. Emotional awareness. This is pretty important, especially when you're just starting out. In a volatile market, emotions can significantly impact your trading decisions. So when you track and analyze your emotions during different trades, it can help you to be aware and identify your emotional biases, such as fear or greed, that may lead to impulsive or irrational decisions. Next, we have risk management. Okay, we went through this already, so I'm not going to touch that. Trade planning and execution. We talked about that as well. Accountability and discipline. Yeah, we mentioned that as well. And confidence building, which we mentioned is similar to having a trading plan. So boost your confidence by documenting your successes and learnings, and you can review your progress and build confidence in your trading abilities. So in conclusion, using a trading journal or trading plan provides numerous advantages, but you also have to be sure that you use everything in conjunction with a strong risk management plan and strategy. Yeah, and it can help you to enhance your skills and refine your strategies and achieve long-term success in the markets. Okay, that brings us to the end of today's webinar. Thank you guys so much for joining me today, and I hope you guys found it helpful. All the best in your trading journey and have a great week ahead. Bye, guys.